Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at some of the fastest dividend growth companies on the market right now. We're going to go over 5 dividend paying stocks who have a current starting yield above 2% and pay out a fast growing dividend to their shareholders each and every year. And the 5-year dividend CAGR for all the companies in this video is currently above 12%. So you're getting a rapidly fast growing dividend, so you collect more and more passive income each and every year just from holding your underlying investment. So in this episode, we're going to take a look at 5 different stocks that all operate in different sectors of the market, go over their current financial information, take a look at their revenue growth, their earnings growth, the dividend growth, and of course some other basic financial stats, and do a quick overview of each individual company that may be worth taking a look at for your very own dividend growth portfolio. But before we jump into stock number 1, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and of course we track the progress of my personal portfolio that now sits at a value of $176,000. So please hit that like button and subscribe to the channel. And now we're going to jump straight in to the first fast dividend growth company you can buy right now, and that is ticker AVGO for Broadcom. The company currently trades for $581 per share, and this is one of the strongest companies in the semiconductor industry. Over the past 12 months, the share price has seen a slight decline in the red by 6.4%, and they're now trading at a very reasonable forward PE ratio of only 14.13 and a starting dividend yield at 3.2%, and the company's current market cap is now at $241 billion. And if we take a look at their recent financial performance, Broadcom continues to grow at a rapid rate year over year. Net revenue continues to expand annually, reaching a record high of over $33.2 billion in fiscal year 2022, and as the company continues to expand their top line, their gross margins have been expanding as well. Over the past 5 years, their gross margin has grown from 66.8% all the way up to over 75.6% as of the last fiscal year. And as their margins and the revenue has been growing, so is their adjusted EBITDA, reaching over $21 billion. And why I'm attracted to Broadcom is their massive amounts of free cash flow. Year over year, free cash flow continues to grow to a record high of over $16.3 billion in the trailing 12 months, which is absolutely incredible. And if we jump over to the company's balance sheet, they have over $12 billion of cash, and total current assets sit at $18.5 billion. And if we take a look at the short-term debt on the balance sheet, that currently sits at over $7 billion. So right now they have a current ratio above 2, so over the next 12 months they are in a very strong financial position. And if we take a look at the long-term debt for Broadcom, they have around $39 billion. And the general rule of thumb is that you want the total long-term debt of a company to be no more than 3 times the last year's EBITDA. So if we take a look at the fiscal year 2022 adjusted EBITDA, that's $21 billion. So if we take 21 times 3, we want the long-term debt for Broadcom to not be above $63 billion. So right now they have total long-term debt of around $39 billion, so it's actually below 2 years of EBITDA. So right now I do believe Broadcom's balance sheet is in a healthy position. And if we take a look at that dividend growth, which is the focus of this video, from fiscal year 2016 all the way through fiscal year 2023, the company has a dividend CAGR of 38% annually. 38% annual dividend growth over the past few years, which is absolutely incredible. Back in fiscal year 2016, they paid out $1.94 per share in an annual dividend. That amount has now grown to over $18 per share. So this has been one of the fastest dividend growth companies on the market during the past 8 years. And if we take a look at their dividend scorecard, the current yield is at 3.2%. They're paying out $18.40 per share per year, a very reasonable payout ratio right around 45% of their net income. The 5-year dividend CAGR sits at 28.5%, and they have an 11-year dividend growth streak. And at this current point in time, the dividend is considered safe, coming in with a score of 67 from Simply Safe Dividends. So Broadcom is the first dividend growth company we're going to go over in this episode. Rapid dividend growth from the semiconductor giant, and I do believe going forward over the long term, the semiconductor industry will continue to grow and Broadcom will still show some very strong financial results. So this was stock number 1, and if we jump straight into the second company in this episode, it is ticker HD for the Home Depot. They currently trade for $329 per share and are down over 15% on the 12-month chart. As I'm sure you all know, Home Depot is the largest home improvement retailer in North America. They have thousands of stores all throughout the United States and Canada. And throughout the global pandemic in 2020 and 2021, as everyone was stuck inside their homes, they spent their excess savings to actually improve their living space, so Home Depot saw a major boost in revenue throughout 2020 and 2021. So the fear throughout 2022 is that increase in revenue was going to decline because consumers has already spent their savings improving their house over the past 2 years. And once you could go outside again, people would spend money on outdoor activities rather than improving their homes. So of course, if we take a look at Home Depot's income statement, they did see a major boost in revenue over the past few years. Back in fiscal year 2018, they generated $100 billion of total sales. That saw a rapid increase to over $151 billion through January of 2022. So a 50% increase in top line revenue in a matter of 4 to 5 years. But one thing to note throughout 2022, some investors were expecting total revenue to decline, but Home Depot has done the opposite. In the trailing 12 months, they've generated a growth rate, a positive growth in sales to now over $157 billion in the trailing 12 months. So of course, the rapid expansion has decelerated, but the company is still expanding their top line at a good rate quarter after quarter. And if we take a look at their profits, as revenue has grown, so has total net income that has more than doubled in the past 5 years to over $17 billion. And as the company's been able to grow their total profits, they've been buying back a ton of their shares quarter after quarter. So not only are you getting a massive dividend that continues to compound rapidly at a fast rate, you're getting more and more equity built up as the company continues to buy back shares every single quarter, returning billions and billions of dollars to us shareholders. And if we take a look at that dividend, the current yield is at 2.3%. Their annual payout per share is at $7.60, a payout ratio right around 45%, and their 5-year dividend CAGR is at a very impressive 16.38%. So again, that dividend is compounding at a very fast rate with a current dividend growth streak of 13 years. And for this dividend, the current safety score is at 87, which is considered very safe, and it's highly unlikely we see a dividend cut coming from Home Depot anytime soon. So this was the second dividend growth company I want to share with you in this episode. And now if we continue on straight into stock number 3, we have ticker UNP for Union Pacific. This is one of the largest railroad companies in the world. Ticker UNP currently trades for $214, and over the past 12 months, they are now down over 13%. The company trades on the low end of the 52-week range with a current forward PE ratio of 18.7, a dividend yield at 2.43%, and a current market cap at $137 billion. So railways are very boring businesses. Many investors don't even consider them for their portfolio because they're not flashy and they're never in the news. But Union Pacific is the definition of a boring company that produces great total returns for shareholders over the long term, and I do own railroads in my personal portfolio as well. If we take a look at their income statement, we can see top-line revenue growth has been expanding over the long term from $21 billion back in 2017 to over $24.4 billion in the trailing 12 months. But if we go year by year, the revenue growth is nothing extensive. They have ups and downs depending on the cycle of the economy, but overall, because of the oligopoly nature of the railroad industry, this company will continue to generate more and more revenue each and every year over the long term just due to raising prices from their recurring customers. And with Union Pacific, although the company's top-line sales haven't been increasing in any dramatic way, they continue to produce more and more cash from their operating activities each and every year. So we can see back in 2013, they generated $6.8 billion from their operating activities, and the cash flow continues to grow to over $9.6 billion in the trailing 12 months. And like we saw, top-line revenue growth hasn't been growing rapidly, but over the past quarter, EPS continued to grow at a dramatic rate, and their earnings per share grew to $3.05, up 19% over 2021. So because of their ability to reduce costs, increase their margins, they are able to grow their earnings per share at a faster rate than the top-line revenue growth. And what the company does a great job of doing is buying back more and more shares every single quarter, which of course helps the EPS metrics. Union Pacific has absolutely devoured their outstanding shares. From around a decade ago, they had 1.01 billion shares outstanding. That currently sits at around 622 million shares. So they've done a great job reducing their shares outstanding year after year. And if we take a look at their dividend, current yield at 2.43%, again, a very reasonable payout ratio right around 44% of their earnings, with a 5-year dividend CAGR of 15.42% and a 16-year consecutive streak of dividend growth. And this is another company that pays out a very safe dividend, coming in with a score of 88, so very unlikely we see a dividend cut coming from Union Pacific anytime soon. Once again, very similar to Home Depot in that regard. So Union Pacific was the third company we're going to talk about in this video, and now if we continue on straight into stock number 4, we have ticker KR for Kroger. They currently trade for $45 per share, and they're only down a minimal 3% on the 12-month chart. The company is trading very close to the 52-week low. They have a very reasonable forward PE ratio of only 11, a current yield at 2.28%, and a market cap just above $32 billion. So of course this is a grocery retailer, and this is a store that will always get continuous revenue and continuous customers regardless of the economical period. And if we take a look at their latest investor presentation, they believe going forward over a longer term period, they can give total shareholder returns between 8 to 11% annually. The market over the long term returns 7 to 9% over a prolonged period. So Kroger believes they can actually slightly outperform the market on the high end of their range by giving you 3 to 5% net earnings growth each and every year, and by paying out a growing dividend and buying back shares, which will return 5 to 6% of cash to their investors each and every year as well. So of course, if you combine both of these metrics, that's where they get their expected 8 to 11% total shareholder return going forward. And if we take a look, they plan to actually grow their earnings by 3 to 5% per year by having 2 to 4% sales growth and 1 to 2% average margin expansion. So as the company sells more, they want to increase their profitability per dollar of sales, which will lead to the 3 to 5% sustainable net earnings growth. And I do believe this is an actual attainable metric. A lot of companies go out there and project long-term sales growth for mature companies and long-term earnings growth 7, 8, 9% annually. For a mature company, especially in the grocery industry, that's very unreasonable. So to average and to expect 3 to 5% net earnings growth based on clear-cut metrics, I do believe is very achievable. And if we take a look over their recent performance, they're absolutely crushing these expectations. So their total shareholder return model represents shares growth of 2 to 4% in top line revenue. Over the past 3 years from 2020 through 2022, they've actually grown sales by 5.3% per year. Operating profit growth was expected to be between 3 to 5%. They've actually been able to grow it by over 12%. Earnings per share, they were averaging 6 to 9% in their model. That's actually been growing at over 20%, which is absolutely incredible. And their total shareholder return during the past 3 years, even though they've been projecting 8 to 11%, has been 22% annually, which is absolutely remarkable. And like we saw, a key driver of their net earnings growth was the fact that they'd be buying back more and more shares, contributing to that total stockholder return. So they had around 1.3 billion shares outstanding back in 2010. That number continues to decline to around 0.7 billion as of the latest quarter. So Kroger is definitely another company that returns a ton of capital to their investors while also paying a growing dividend. The current yield sits at 2.3%, a very, very minimal and extremely safe payout ratio of only 23% of their earnings per share, and they've been growing that dividend at a CAGR of 14% over the past 5 years, with a 16-year streak of consecutive dividend growth. And if we take a look right now, the company's dividend is considered safe with a score of 71. And during the past year, in June 2022, they grew their dividend by 24% annually, so a major increase in that payout during their past year where they had some very strong financial performance. So Kroger was stock number 4. The grocery retailer often gets overlooked because they have a boring business, but I do believe they will be able to achieve their total expectations for shareholder return. And if you can get 10 to 11% annual growth, including dividend reinvestment, share buybacks, and overall earnings growth from a company like Kroger, which is a very simple to understand business model, they're not a very volatile stock, it's definitely worth taking a look at for your portfolio, especially because they've been growing that dividend with an average CAGR of 15% over the past 5 years. And now if we continue on into the fifth and final company we're going to go over in this episode, it is ticker UPS for United Parcel Service. The company currently trades for $182 per share, and they're down over 13% on the 1-year chart. The company's current forward PE ratio sits at 14.1. They have a dividend yield at 3.3%, with the current market cap at $157 billion. And of course, as we all know, the demand for online shopping has absolutely exploded over the past 5 years, and all those goods purchased online need to be shipped. So UPS's business has seen a major expansion during that period. Back in 2017, they generated $66.5 billion of total top-line sales that has now grown to over $100 billion in the trailing 12 months. And over that period, gross profits have seen a major expansion to right around $25 billion. And as total sales continue to grow, so has the company's earnings. Over the past quarter, operating margins have improved to 12.9%, up 40 basis points, and their diluted EPS grew 11.7% over 2021. So each and every year, the company continues to grow their earnings at a double-digit rate, which is great to see. And if we take a look at their cash flow from operations in the first 3 quarters of this year was at $10.8 billion. Their total free cash flow was at $8.5 billion. This company continues to produce a ton of free cash flow year in and year out. And overall, they've seen a major increase in their dividend during this past year from around $1.02 per share up to $1.52 during the latest dividend increase. So of course, this company has continued to grow their payment every single year. Throughout the pandemic, they only did a slight increase, but they maintained their dividend growth streak. But they actually improved their dividend by over a 40% increase as of the latest raise, and they did it to make up for the minimal raises in the prior years. And if we take a look at that dividend, the current amount comes in at $1.52 per share per quarter. That gives them a yield at 3.34%, a payout ratio of 43% of their net income, and their 5-year dividend CAGR is at 12.86%, with a 13-year streak of consecutive dividend growth. And of course, this company does also pay out a safe dividend with a current score of 69. And of course, like we could see, their last dividend growth was 49% during this past year. Because of the minimal growth in the past few years, they bumped it up because now they've gone out of the pandemic, the business is thriving, and overall UPS has seen a major bump in their annual passive income to each and every shareholder. So overall, this was the 5th and final company we're going to take a look at in this episode. We went over 5 dividend growth stocks that have a current yield above 2%. So you're getting in an above market starting dividend yield, with all these companies paying out a fast growing dividend each and every year above 12%. We saw a massive range in dividend growth. These companies are growing earnings, they're growing cash flow, they're buying back more and more stock each and every year. And these are the type of investments you want to make in a strong dividend growth portfolio. You don't have to chase the high flying names. Boring, sustainable businesses that produce results year in and year out, have positive free cash flow numbers, return capital to shareholders, are exactly what you want to look for a dividend portfolio. So definitely worth taking a look at some of the names we mentioned in this video. Please let me know down in the comments if you have any other companies that you believe have strong dividend growth metrics and will continue to grow their dividend at a fast rate going forward, and I will definitely check them out. So thanks for watching. See you in the next episode.